Welcome to the audiobook, The Psychology of Money by Morgan Housel. This book isn't about financial formulas or get-rich-quick schemes. It's about understanding how and why people behave the way they do with money. And as Morgan Housel points out right from the start, that behavior has far more impact on financial success than intelligence, market knowledge, or even income. You see, most financial decisions aren't made in spreadsheets. They're made in real life, during stressful moments, late nights, and conversations over dinner. They're influenced by childhood memories, cultural values, fears, dreams, and even what our peers are doing. That means the way we deal with money is deeply personal. It's emotional. It's often messy. And it's not always rational, at least not by textbook standards. But here's the key message. That doesn't mean we're wrong or broken. It means we're human. Morgan Housel wants to shift the focus from what we should do with money to what we actually do and why. He shows us that two people with the same resources can make wildly different choices, not because one is smarter, but because their life experiences shaped how they see risk, reward, and success. Throughout the book, Housel blends stories from history, economics, and psychology to reveal how wealth is built, preserved, and often lost, not by financial formulas, but by our decisions, habits, and expectations. He breaks down the myths that wealth always follows logic or effort. Instead, he shows how luck, patience, humility, and restraint often play bigger roles. One of the most refreshing truths this book offers is that you don't need to be a financial expert to build wealth. You don't need to predict the market, beat competitors, or hustle nonstop. What you need is the ability to control your behavior, to delay gratification, to stay calm in chaos, and to understand what enough means for you. This book also challenges a key idea, that wealth is visible. In reality, many people who look wealthy are deeply in debt. And many who are truly wealthy fly under the radar because they've mastered the most powerful financial skill of all, saving and investing quietly over time. As you turn the pages, you'll be invited to explore big questions. Why do smart people make bad financial decisions? What role does emotion play in investing? How can you create a financial life that's both stable and satisfying? Ultimately, the psychology of money is about building a healthy relationship with money, one rooted in awareness, discipline, and clarity about what matters most to you. Whether you're starting your financial journey or reevaluating your path, this book offers something better than tips. It offers timeless insights into the mindsets and habits that create real, lasting wealth. Chapter 1: No One's Crazy. When it comes to money, people don't act based on facts. They act based on their experiences. That's the central idea Morgan Housel unpacks in this chapter. Let's start with a simple truth. Everyone's financial behavior is shaped by the time and place in which they were born. If you grew up in poverty, your relationship with money is likely rooted in caution, frugality, or fear. If you were raised in abundance, you might be more comfortable taking risks or spending freely. If you lived through a financial crash, you probably carry that scar in your decision-making, even if the market has since recovered. This means people aren't irrational, they're just shaped by different realities. Take investing, for example. Someone who came of age during the 1970s, when inflation was high and markets were volatile, might avoid stocks entirely. Meanwhile, someone who started investing after the 2008 recession and saw a decade of growth might think stocks are always safe. Both views make sense, given their personal histories, even if they contradict each other. The point is, there is no single, rational way to handle money that applies to everyone. Your decisions might look strange to someone else, but they're perfectly logical in the context of your own life. That's why judgment is often unhelpful in finance. We're all playing a game with different rules. Housel uses this idea to challenge the way financial advice is often given. Most financial plans assume a kind of rational actor, someone who makes choices based only on math. But in real life, people don't operate that way. We bring emotion, memory, and even trauma into every financial choice we make. Here's a powerful takeaway from this chapter. You don't need to optimize your financial decisions, you just need to make them reasonable for you. Trying to be perfectly rational might push you toward risky strategies you don't understand or can't tolerate. But if your plan is grounded in your values and comfort level, even if it's not optimal on paper, it's more likely to work over the long run. Housel also reminds us that much of what happens in finance is driven by behavior, not intelligence. Plenty of smart people make bad money decisions because they don't understand their own psychology. And many modest earners build great wealth because they're consistent, humble, and patient. The final lesson of the chapter is deeply empowering. Give yourself permission to do what makes sense to you. Stop trying to follow a path that works for someone else. Understand your story, your patterns, and your needs. From there, you can build a financial life that's not just smart, but also deeply personal and sustainable. Chapter 2: Luck and Risk. In this chapter, Morgan Housel explores a truth that often makes people uncomfortable when it comes to money. Success isn't always earned, and failure isn't always deserved. Much of what happens in life, especially in finance, is influenced by things outside our control: where we were born, when we were born, who we met, or what random event shaped our path. That's where luck and risk come in. Housel begins by highlighting the story of Bill Gates. Gates was clearly brilliant and hardworking, but he also had rare access to a computer in high school in the 1960s, long before most people even knew what a computer was. That opportunity gave him a head start most others never had. Was it skill? Yes. But also, a massive dose of luck. He contrasts this with another student from the same school who was equally smart but tragically passed away young. One person's potential led to billion-dollar innovation. Another never got the chance. It's a sobering reminder. Outcomes often depend on luck just as much as effort. The flip side of this is risk. Just as luck can lift someone up, risk can pull someone down, even if they do everything right. You might save carefully for years and still face a surprise medical bill. Or build a business with integrity and still lose it to market conditions. In both luck and risk, circumstance plays a bigger role than we like to admit. Housel isn't saying skill doesn't matter, but he is saying we need to make room in our thinking for humility. If you're successful, it's wise to be grateful rather than smug. If you're struggling, it's important not to blame yourself for every setback. And here's where the psychology kicks in. People tend to copy others' financial behavior without knowing what role luck or risk played in their success. You might try to mimic an investor who took huge risks and got lucky, not realizing that same move could bankrupt you. That's why Housel encourages us to study broad patterns, not just individual stories. The takeaway from this chapter is simple, but powerful. Be kind, be humble, and be cautious. Recognize that your financial journey is shaped by your choices and your circumstances. Plan for uncertainty, don't overestimate your control, and never judge someone's outcome without knowing their full story. We all live at the intersection of luck and risk. The goal isn't to eliminate uncertainty, it's to build resilience so you can thrive despite it. Chapter 3: Never Enough. In this chapter, Housel explores one of the most dangerous financial traps: the inability to know when you have enough. It's a mindset that leads even successful people to take unnecessary risks, chase more for the sake of more, and sometimes lose everything. He begins with a sobering story. Rajat Gupta, a highly respected businessman who built an extraordinary life from humble beginnings, had already achieved immense wealth and success. But wanting to be a billionaire like others around him, he engaged in insider trading and ended up in prison. Why? Because enough was never enough. Housel uses this story to highlight something powerful. The hardest financial skill is getting the goalpost to stop moving. Once you have more than you need, the desire for more becomes a race with no finish line. You might start out wanting comfort and freedom, but eventually you compare yourself to those with yachts or islands, and you feel behind. That's the danger of tying happiness to relative wealth instead of absolute contentment. There's always someone with more. If your sense of success is tied to beating others, you'll never feel secure. The lesson isn't that ambition is bad. Ambition fuels growth and innovation. But without boundaries, ambition can become greed, and greed leads to risk-taking that rarely ends well. Housel also emphasizes the importance of defining what enough looks like for you, not for society or your peers. Enough might be financial independence, the ability to spend time with loved ones, or the peace of knowing you can weather a storm. Whatever it is, you have to name it and honor it. Because once you do, you start making decisions based on your values, not your ego. You resist pressure to overspend or overwork just to keep up. You gain confidence in simplicity, and you protect what you've already built. The core message of this chapter is simple and deeply freeing. Enough is the antidote to endless striving. It helps you avoid ruin, preserve happiness, and find clarity in a noisy financial world. Chapter 4: Confounding Compounding. In this chapter, Housel introduces one of the most misunderstood yet incredibly powerful forces in finance: compound growth. The lesson is simple but often underestimated. Tiny, consistent gains over time lead to extraordinary outcomes. Yet, because compounding works slowly at first, many people overlook or abandon it too early. He begins with a surprising example: Warren Buffett. Yes, Buffett is known as one of the greatest investors of all time, but what makes his story exceptional isn't just his investing skill. It's the fact that he's been investing since he was a child and has stayed in the game for over 75 years. The bulk of his massive net worth came after he turned 50. That's the magic of compounding. Patience multiplies growth. Housel points out that we often focus on the short term, the next big win, the hottest stock, or the fastest way to make money. But the real power in building wealth lies in consistency and time. You don't need to swing for the fences. You just need to keep showing up and letting your money work while you sleep. The problem is, our brains are not wired to intuitively understand exponential growth. We think in straight lines, so we don't grasp how powerful doubling can be over years and decades. That's why we often get impatient when results don't show up quickly. But with compounding, the most powerful outcomes happen later, when years of growth begin to snowball. And it's not just about money. Compounding applies to reputation, relationships, habits, and knowledge. Small improvements in any area, if repeated over time, can create massive transformation. The key, Housel says, is to focus less on big wins and more on never interrupting the compounding process. That means avoiding the urge to chase trends or pull money out prematurely. It means staying calm in market downturns. And most of all, it means understanding that time is your most valuable financial asset. The core takeaway: good investing is not necessarily about earning the highest return, it's about earning pretty good returns for the longest period of time. When you give compound interest the time it needs, it rewards you far more than any quick fix or clever trick ever could. Chapter 5: Getting Wealthy versus Staying Wealthy. In this chapter, Housel makes an important distinction. Getting wealthy and staying wealthy are two different skills. Many people focus all their energy on building wealth, but very few learn how to protect and preserve it. And yet, it's the second skill, staying wealthy, that determines whether success lasts. To get wealthy, you often need optimism, risk-taking, and boldness. Starting a business, investing early, or taking career leaps all require courage and belief in the future. But once wealth is achieved, the mindset must shift. To keep wealth, you need humility, fear, and caution, and a clear awareness that things can go wrong at any time. Housel reminds us that history is full of examples of people who built fortunes and lost them just as fast, often because they kept taking the same level of risk even after they'd already won the game. They assumed their luck would last forever. But long-term financial success is less about being aggressive and more about being survivable. It's about protecting yourself from the downside, staying in the game long enough to benefit from long-term growth, and making sure one mistake doesn't erase years of progress. He emphasizes 3 key traits of people who stay wealthy. 1. Frugality, not necessarily being cheap, but having a healthy respect for risk and a preference for stability over flashy spending. 2. Paranoia, maintaining an awareness that nothing is guaranteed, and building in buffers for when things go wrong. 3. Flexibility, adapting as circumstances change, and not locking yourself into rigid strategies that might fail under pressure. In practical terms, this might mean keeping more cash than seems efficient, living below your means even when you can afford more, or diversifying your investments. These choices might look overly cautious, but they're actually what keeps people afloat when markets crash or life throws curveballs. The message is clear. Getting rich is only half the battle. To build lasting financial peace, you must protect what you've earned. And that means making choices that favor endurance over excitement. Chapter 6: Tails You Win. This chapter introduces a surprising truth about success, both in money and life. Most big outcomes come from a few small moments or tail events. These are rare, extraordinary occurrences that outweigh all the average, everyday result. Housel explains that in investing, and in many areas of life, a small percentage of actions or outcomes generate the majority of returns. In the stock market, for example, just a handful of companies are responsible for nearly all the long-term gains. Most investments barely break even or lose value, but a few outliers, like Apple or Amazon, make up for the rest. He calls this concept tails, short for tail-end events, referring to the thin, far ends of the bell curve where rare outcomes live. It might seem unfair or random, but this is how nature, business, and success often work. In fact, almost everything meaningful is the result of a tail event, from major scientific discoveries to unexpected career opportunities. So what's the takeaway? Housel argues that smart financial thinking means accepting this reality, not fighting it. That means being patient enough to wait for the rare, game-changing wins instead of expecting every move to deliver massive result. Diversifying so you give yourself more chances for tail events to occur. Not overreacting when things don't go your way in the short term, because long-term success often depends on a few rare breakthroughs. This chapter also reminds us to be kind to ourselves when most efforts don't lead to huge success. If you've tried 10 things and only one really paid off, that's not failure. That's how the world works. It's the same with saving. A few good years of investing or a few smart decisions can do more for your future than decades of average returns. And in your career, one lucky introduction or opportunity might change everything. The key message is powerful. You don't need everything to go right. You just need a few things to go extremely right, and then you need to not mess it up. So let the tails work in your favor. Create space for luck. Stay consistent. Keep going. Because when those rare winning moments do come, and they will, they'll make all the difference. Chapter 7: Freedom. In this chapter, Housel explores what he believes to be the highest dividend money can pay: freedom. More than status, more than luxury, more than even security, freedom is the real goal behind building wealth. And what is freedom? At its core, it's the ability to do what you want, when you want, with whom you want, for as long as you want. It's control over your time. And that, Housel argues, is the deepest form of wealth. Think about it. Most people don't want to be super rich just to swim in gold coins. They want what they think money will give them: peace, flexibility, and the power to make choices. That might mean retiring early, working part-time, taking a sabbatical, or just not feeling trapped in a job or lifestyle that drains them. Housel emphasizes that time is the only non-renewable resource we have. And money, when managed wisely, can give us more control over how we use our time. that might be more valuable than any object money can buy. But here's the twist: most people trade their time for money, and then trade that money for things that cost them even more time. Bigger homes, fancier cars, and high expenses lock people into needing higher incomes, which demands more work, which reduces freedom. It's a cycle that keeps people from experiencing the very thing they hoped wealth would bring. That's why Housel encourages us to define what freedom means personally, and then to structure our financial lives around achieving that, not chasing someone else's definition of success. He offers this practical advice. Live below your means. Not just to save money, but to give yourself options. Build a buffer so you're not financially vulnerable to every bump in the road. Prioritize time over status. It's easy to measure wealth in dollars. But real wealth is how much of your day you control. Ultimately, this chapter is a reminder that money itself isn't the goal, it's a tool. And the best way to use that tool is to buy yourself time, autonomy, and the ability to design a life that reflects your values. Chapter 8: Man in the Car Paradox. In this chapter, Housel tackles a common illusion in how we view wealth. We assume people admire us for the things we own, but in reality, they usually don't. He calls this the man in the car paradox. Here's how it works. You see someone driving a flashy car, wearing expensive clothes, or showing off a luxurious lifestyle. You don't think, wow, that person must be successful. Instead, you likely think, if I had that car, people would admire me. You're not actually admiring the person, you're imagining admiration for yourself. That's the paradox. When people chase symbols of wealth to gain respect or attention, it rarely works the way they think. Because while they hope others will be impressed by their success, most people are too focused on their own lives to notice, or they admire the object, not the owner. This realization leads to a powerful insight. The desire to be admired can drive financially dangerous behavior. Buying things you can't afford to impress people who aren't even paying attention is one of the fastest paths to financial stress. Housel isn't saying you should never enjoy nice things. He's saying if your main motivation is external approval, the satisfaction will always be fleeting. It's a reminder that true wealth isn't what people see, it's what you don't see. The money saved, the debt avoided, the freedom quietly earned. This chapter encourages a subtle shift in mindset. Focus on quiet wealth, not performative spending. Understand that admiration rarely comes from appearances, it comes from character, generosity, and confidence. Recognize that respect is earned by how you treat people, not what you own. The core message is this: it's okay to enjoy your success, but never build your financial identity around impressing others. Most of the admiration you're chasing is an illusion. Chapter 9: Wealth is what you don't see. In this chapter, Housel expands on an idea that's easy to overlook in today's culture of visible success. Real wealth is invisible. It's not in the cars, clothes, or homes, it's in the money you don't spend. It's the assets you quietly build and the choices you make to delay gratification. He explains that what we typically think of as wealth is often just spending. When someone drives an expensive car, we're seeing how much they chose to spend, not how much they saved, invested, or secured for their future. And yet, we often mistake spending for success. The truth is, most people who appear wealthy are simply high earners with high expenses. They might have a great income but very little margin or security. Meanwhile, people who live modestly and save consistently may be far wealthier, though you'd never guess it by looking at them. Housel makes a strong case for redefining wealth. He says wealth is the financial freedom that comes from owning your time, building resilience, and having choices. And the only way to build that kind of wealth is to save money, and not show it off. Saving is the difference maker. Not because of how much you earn, but because of how little you need to feel content. Saving gives you control. It gives you options. It gives you time. Here's the key idea. Spending is easy, saving is subtle. And because it's subtle, it's often undervalued. But in the long run, it's what truly builds wealth. Housel encourages us to embrace this perspective. Be proud of what you've saved, not what you've spent. Understand that flashy spending often hides financial fragility. Focus on building wealth you don't need to advertise. The goal isn't to look rich, it's to be rich quietly. Because the greatest luxury isn't attention. It's freedom, peace of mind, and the ability to say no when it matters most. Chapter 10: Save Money. This chapter is a straightforward yet powerful message. Saving money is the foundation of financial success. It may not be flashy, but it's one of the most controllable and reliable tools for building wealth and security. Housel begins by pointing out a truth that often goes overlooked. You don't need a reason to save. Most people think saving is only necessary for a down payment, retirement, or an emergency. But saving just because gives you flexibility when life surprises you, which it always does. Unexpected expenses, job losses, sudden opportunities. These things don't announce themselves. And if you've saved out of habit, not just for a specific purpose, you're ready. Savings give you control over your time, decisions, and peace of mind. They're not just financial, they're emotional insurance. He also emphasizes that building wealth isn't always about earning more, it's often about spending less than you could. Many people increase their income but increase their lifestyle just as fast, leaving them with the same stress and vulnerability. Saving is where freedom begins. When you live below your means and build a cushion, you create a space between what life throws at you and how badly it can hurt. You buy time. You gain choices. You reduce panic. Housel makes another key point. Saving is 100% in your control. You can't always control market returns, job promotions, or interest rates, but you can control how much you set aside. That makes it one of the few financial strategies that works in all circumstances. His advice? Save consistently, even small amounts add up. Save more when you can, especially during good years. Don't wait for a reason, just make saving a habit. Recognize that savings bring freedom, not just security. Ultimately, this chapter reframes saving not as sacrifice, but as empowerment. It's how you take care of your future self, and it's the simplest, most universal path to wealth. Chapter 11: Reasonable, Rational. In this chapter, Housel challenges a common assumption in personal finance, that the goal should always be to make perfectly rational decisions. Instead, he argues you're better off aiming for decisions that are reasonable, because they're the ones you're most likely to stick with. Rational means mathematically or logically optimal. But personal finance isn't just math. It's emotion, history, values, and psychology. What's right on paper might not feel right in real life. And if it doesn't feel right, you're less likely to follow through or stay consistent. For example, you might hear that the best financial strategy is to invest aggressively for maximum returns. But if watching the market drop makes you anxious or impulsive, then a less aggressive, more comfortable plan is better for you, even if it earns slightly less. Because the most important part of any plan is your ability to stick with it long term. Housel uses this idea to explain why many people keep large cash savings, even when it might not be the most efficient investment. To a financial expert, it might seem irrational, but to a regular person, the emotional comfort of knowing they have money readily available is deeply valuable. And that peace of mind helps them stay calm, sleep better, and feel secure. He says that good money decisions are not always about maximizing returns. They're about balancing returns with peace of mind, sustainability, and lifestyle. The key takeaway is this: financial success is more about behavior than precision. You're better off with a plan that's pretty good and feels right than a plan that's perfect but keeps you up at night. So how do you apply this? Choose strategies you can live with for decades, not just years. Don't chase optimal if it doesn't match your personality or values. Accept that feelings are part of money decisions. Use them, don't ignore them. In the end, Housel says the best financial plan is the one that works for you. It might not be rational by the book, but if it's reasonable for your life, your stress level, and your goals, that makes it wise. Chapitre 12, Surprise. In this chapter, Housel emphasizes a critical truth about financial planning. The most important events that shape your financial life will often be surprises, things no one saw coming. And because they're unpredictable, traditional forecasting often fails to prepare us for them. He starts by pointing out how much of history, especially financial history, has been shaped by completely unexpected events. Think about the 2008 financial crisis, the COVID-19 pandemic, or even major stock market crashes. Almost no one predicted these with precision, yet they changed everything. The lesson? We tend to plan for the future based on the past, but the future almost always looks different. This doesn't mean planning is useless, but it means our plans need to include room for the unknown. Rather than assuming we can predict every turn, we should build flexibility into our financial decisions. Housel encourages us to focus on resilience rather than precision. For example, keep more cash than feels optimal to buffer against the unexpected. Diversify your investments, not just to grow wealth, but to protect against surprises. Avoid rigid financial plans that fall apart when life doesn't follow your script. He also reminds us to be careful when drawing lessons from history. We often treat past events as if they were inevitable, when in reality, many of them were unexpected or made worse by unpreparedness. And when you base your financial strategy entirely on what has happened, you might miss what could happen. The core takeaway: prepare for a world where surprises are the norm, not the exception. Embrace humility. Expect the unexpected. And design your financial life to bend without breaking. It's not about predicting the next crisis. It's about surviving whatever happens next. Chapter 13, Room for Error. This chapter builds on the last by introducing a critical principle for smart financial planning: leave room for error. Housel argues that success isn't just about making good decisions, it's about giving yourself enough margin to survive when things go wrong. No matter how well you plan, life has a way of surprising you. Jobs change, markets drop, health fails, and if your plan assumes everything will go right, you'll be in trouble the moment something doesn't. That's why the most successful people and investors prepare not for the best-case scenario, but for the unexpected. He uses the analogy of engineers building bridges. They don't design bridges to support exactly the expected weight, they add a safety margin. That way, even if a heavier load crosses, the bridge stands. We should do the same with money. In practical terms, this might mean saving more than you think you need, spending less than you can afford, investing with buffers so one mistake doesn't wipe you out. Housel explains that room for error isn't about pessimism, it's about staying in the game. You don't have to be perfect. You just have to survive the hard times, and by leaving yourself some breathing space, you make it more likely you'll stick to your plan long enough for it to work. He also warns against the danger of overconfidence. Many people get into trouble not because they made poor choices, but because they assumed they were immune to risk. They overleverage, overspend, or overinvest, and one unexpected event is all it takes to unravel everything. The wisdom here is timeless: play it safe when it really matters. Especially when you're close to your goals, protect what you've earned. As Housel puts it, you have to take risk to get ahead, but you need to avoid ruin to stay ahead. The big message: resilience matters more than brilliance. The people who win in the long run aren't always the smartest. They're the ones who stay in the game the longest. Chapter 14, You'll Change. In this chapter, Housel highlights a simple but often overlooked truth. We change over time, our goals, values, priorities, and preferences evolve. Yet many people make long-term financial decisions as if they'll always want the same things they want today. This is called the end of history illusion. It's the tendency to believe that while we've changed a lot in the past, we won't change much going forward. But in reality, you're likely to be a very different person in 10 or 20 years, and that has serious implications for how you plan your financial life. For example, you might think you'll want to retire early and live abroad, but discover later that you'd rather stay close to family. Or you might build an aggressive investment strategy for the next 30 years, only to realize 5 years in that the stress of risk isn't worth the returns. The key message here is that your financial strategy needs flexibility. It's dangerous to lock yourself into rigid plans or long-term commitments without room to adjust. The best plans anticipate that future you might think differently than present you. Housel encourages a mindset of humility and adaptability. Avoid tying your identity to a specific financial goal. Be cautious about overcommitting to ideas that can't be changed. Accept that change is natural and prepare for it, not resist it. He also reminds us that financial regret often comes from assuming that today's desires will last forever. People spend years chasing a lifestyle they thought they wanted, only to realize too late that their priorities have shifted. So instead of aiming for forever answers, aim for resilient systems that work even as you evolve. That means building buffers, diversifying your life options, and always giving yourself permission to pivot. The takeaway: don't fight change, design for it. Financial wisdom isn't about locking in the perfect plan. It's about creating a life that's flexible enough to grow with you. Chapter 15: Nothing's Free. In this chapter, Housel focuses on a powerful concept. Everything has a price, especially in investing, but not all prices show up as dollar signs. Sometimes, the true cost of building wealth comes in the form of volatility, uncertainty, stress, or time. Too often, people try to avoid this cost. They want the gains without the discomfort. But the truth is, there's no such thing as a free reward. If you want higher returns, you have to accept greater risk. If you want the calm of a savings cushion, you have to accept the discipline of spending less. One of the key ideas Housel explains is that market downturns, temporary losses, and scary headlines are not mistakes. They're part of the fee. They are the price of admission for long-term growth. And if you treat them like punishments instead of expected costs, you're more likely to panic and quit too early. This chapter challenges the mindset that financial discomfort is a signal to stop. Instead, Housel reframes it. If you're feeling discomfort, it might mean you're paying the price that wealth requires. And like anything worthwhile, education, health, relationships, if you're not willing to pay the price, you don't get the benefit. He compares it to going to Disneyland. The ticket isn't cheap and the lines are long, but people pay anyway because they believe the experience is worth it. The same applies to investing. If you want the long-term gains, you have to decide up front that the occasional stress is worth it. The takeaway is empowering. Don't avoid the cost, prepare for it. Accept it. Budget for it emotionally. That way, when the tough moments come, and they will, you won't be surprised and you won't quit. Housel's advice is simple. View risk and uncertainty as part of the process, not barriers to it. Make peace with the emotional toll that investing or saving might take. It's not a penalty, it's the fee for freedom. Chapter 16: You and Me. In this chapter, Housel dives into a core reason why personal finance can be so confusing. People play different financial games, often without realizing it. What makes sense for one person might be completely wrong for another. Not because either is irrational, but because their goals are different. Think of it like this. A day trader and a long-term retirement investor are operating on totally different timelines. A headline that sends one of them into a buying frenzy might make the other yawn. But if the long-term investor starts copying the day trader's moves, or vice versa, they can both end up making bad decisions. This is why, Housel warns, you have to be very careful about where you get your financial information. Much of the advice you see online, in the media, or even from experts may be rooted in assumptions that don't match your situation. Their game isn't your game. He stresses that context matters. Someone nearing retirement will approach money differently than someone in their 20s. A billionaire can afford to take risks that a middle-class earner cannot. And a person trying to protect their family's future will make different choices than someone seeking adventure. The mistake comes when we compare ourselves to others, thinking we should follow what smart or successful people are doing. But unless their life and goals match yours exactly, their moves might lead you astray. Housel's message is clear. Figure out what game you're playing. Then make sure your strategies, your behaviors, and your financial plans are aligned with that game, not someone else's. His practical advice. Ignore noise that doesn't apply to your goals or time frame. Define your own version of success. Stay grounded in your own values and avoid financial envy. In the end, this chapter is a reminder that financial peace comes from clarity, not just in numbers, but in purpose. Your path is yours. Stick to it. Chapter 17: The Seduction of Pessimism. In this chapter, Housel explores why negative news grabs our attention more than positive news, especially when it comes to money. The idea is simple. Pessimism sounds smart, while optimism often sounds naive. He explains that people are naturally drawn to warnings, threats, and signs of collapse. In finance, a headline about a market crash or economic crisis tends to go viral far more quickly than one about steady growth. That's because losses hurt more than gains feel good, so we're wired to be extra alert to bad news. But here's the twist. Progress in the financial world is usually slow and steady, while problems show up fast and loud. Good news happens gradually and quietly, it's long-term. But bad news, like recessions or layoffs, feels immediate and urgent. That creates a bias where we think things are worse than they actually are. Housel argues that this pessimism bias can lead people to make poor decisions out of fear. For example, someone might pull out of the stock market because they're scared of a downturn, even though the long-term trend is upward. Or they might avoid opportunities because they expect the worst. The reality is, the world improves over time, even if it doesn't feel like it in the moment. Economic growth, innovation, and human resilience have moved us forward for centuries. But since progress is slow and problems are dramatic, we often overlook just how much good is quietly unfolding. The big message? Don't let pessimism blind you to progress. Be cautious, yes, but also be fair. Understand that fear sells, but it's not always accurate. The most successful investors and savers are those who stay grounded, stay optimistic, and trust in long-term resilience. Practical advice from this chapter. Question whether negative headlines reflect long-term reality. Be aware of how fear influences your financial decisions. Remember that setbacks are normal, but so is recovery. Housel's final insight here is simple but powerful. Optimism doesn't mean ignoring risk. It means believing that we'll find ways to overcome it. Chapter 18: When You'll Believe Anything. This chapter looks at a subtle but dangerous aspect of human psychology, how easily we can convince ourselves of almost anything, especially when money is involved. Housel explains that when our self-worth, dreams, or fears are tied to financial outcomes, we're more likely to create stories that justify risky or irrational behavior. He starts with the idea that everyone has blind spots, especially when emotions are high. If you really want something to be true, like believing an investment will keep going up, you'll find a way to convince yourself. You might ignore red flags, twist the facts, or follow the crowd just to feel safe or hopeful. This happens a lot in bubbles. During market booms, people convince themselves that this time is different, and that prices will never fall. In reality, the signs of a bubble are often clear, but when everyone else is making money, it's tempting to silence your doubts. We want to believe, so we do. Housel also points out that people often overestimate their ability to see things clearly. We think we're being logical when really we're being emotional, and the more money is involved, the more our beliefs become attached to our identity. Here's the danger. Once money becomes personal, it becomes harder to think clearly. We don't just lose money, we feel like we've failed. And that emotional weight pushes us to believe in shortcuts, false promises, or dangerous risk. So what can we do? Housel encourages self-awareness and humility. Accept that your brain is wired to protect your ego, and that means you might believe things that aren't true. The key is to build systems that check your thinking. Surround yourself with people who challenge your ideas, not just echo them. Take time before making big financial decisions, especially when emotions are high. Ultimately, the message of this chapter is this: don't trust every story you tell yourself about money. Step back, ask hard questions, and stay grounded in long-term thinking. Because in a world full of noise, clarity is your greatest asset. Chapter 19, All Together Now. In this chapter, Housel brings together the key lessons from earlier chapters and explains how no single rule works for everyone, and no universal formula guarantees success. Personal finance is just that, personal. What works for one person may be completely wrong for another. He emphasizes that successful financial behavior is not about following perfect rules. It's about adopting a mindset and set of habits that fit your own values, goals, and comfort with risk. This chapter is about integration. By now, we've learned. Luck and risk play bigger roles than most people admit. Saving gives you freedom, not just security. You should define what enough means for you. Wealth is what you don't spend. Tail events matter more than averages. Pessimism sounds smart, but optimism builds wealth. And now, Housel says the real magic happens when you combine these lessons into a cohesive approach that respects your emotions, your unique goals, and the uncertainty of life. He encourages us to build a financial life around consistency, humility, and adaptability. It's not about optimizing every decision. It's about building a system that lets you stick with good habits for decades. This means being okay with pretty good strategies that are sustainable for you. Recognizing that discomfort is part of the price of success. Not comparing your game to someone else's. Adjusting your plan as your life evolves. Housel doesn't offer a step-by-step system, because he believes you have to build your own. But the principles he's shared give you the tools to do that wisely. The final takeaway of this chapter is powerful. The most successful financial strategy isn't the smartest, it's the one you can stick with. So build a system that fits you and keep going. That's how wealth, both financial and emotional, is created. Chapter 20, Confessions. In this final chapter, Morgan Housel turns the spotlight inward. He shares his own personal financial philosophy, not as a universal guide, but as an example of how someone can shape their decisions based on their own values, comfort levels, and life circumstances. He opens by admitting something important: most of what he does with money isn't textbook optimal, and that's okay. It works for him. He invests conservatively. He keeps a large cash cushion. He doesn't maximize every potential gain. Why? Because peace of mind is more valuable to him than squeezing out every last dollar of return. This honesty is the heart of the chapter, and the book's overall message. Personal finance is personal. It's not about finding the smartest or most efficient path. It's about building a system that you'll actually follow. A system that keeps you calm. A system that matches your lifestyle and lets you sleep well at night. Housel reminds readers that what works on a spreadsheet may not work in real life. And you shouldn't feel ashamed for choosing simplicity, security, or flexibility over maximizing returns. Often, the most rational choice is the one that gives you long-term stability and emotional clarity, not just a better number. He also notes that people change. His own financial approach evolved over time, and it will probably continue to evolve. That's part of the process. What matters most is being intentional about your decisions, knowing why you're doing what you're doing, and adjusting when necessary. The final message is this: there is no single right way to manage money, there's only the way that works for you. Be thoughtful, be humble, stay flexible, and most of all, stay consistent. Because wealth, in the end, isn't just about numbers. It's about building a life with room to breathe.